Hi everybody, and welcome back to video number 4 in chapter 20. And when we left off, we were looking at a lease receivable calculation. And Coffee and Beans computes the lease receivable as shown below. Here, the lease receivable is equal to the present value of the rental payment plus the present value of the guaranteed residual value. Very straightforward here, I think. The journal entries, therefore, on January 1, 2025 are as follows. We'll debit lease receivable for the full $100,000. We'll debit cost of goods sold for $85,000. We'll credit sales revenue for $100,000 and credit inventory to reduce it by $85,000. Okay, the amortization schedule then is shown as follows, and you can see that it goes from, we have $8,555.55 in interest, so the lease receivable amortizes down, of course, to 0. Okay. Now, the first year's lease payment. What we're going to do here is we're going to take, here's our first year's lease payment up here, and we debit cash because we're receiving that, and credit lease receivable to reduce our lease receivable. Now, in the second year, I should say that on December 31, 2025, they're going to recognize interest revenue here on the lease receivable during the first year through the following entry. And here's that number, $3,171.56, and we'll debit that for lease receivable and credit interest revenue for that amount. Now, the balance sheet as it relates to lease transactions at December 31, 2025. Here, as we show on the current assets, we have the lease receivables. That's the current portion. And then the non-current portion at $61,749.34. So, on the income statement, Coffee and Beans is going to report sales. Here's our sales revenue, our cost of goods sold of $85,000, and other revenue, interest revenue here for $3,171.56. So the receipt of the second year's payment now, we're going to be using this lease amortization schedule here again. And we're going to receive cash on January 1 for $20,711.11 and credit lease receivable to reduce it by that same amount. On December 31, we're going to have our lease receivable is going to increase here, and we will credit interest revenue for that $2,469.97. And now, Coffee Beans is going to make the following entry, final lease payment on December 31, 2029, our last payment here. And that's going to be finally our debit to lease receivable of $192.19 and a credit to interest revenue of $192.19. And finally, our lease receivable amortizes down to 0. Okay, now for the sales type lease example, on January 1, 2030, here, we have at $5,000, the leased asset is returned to coffee and beans. So we'll bring that back into inventory with a debit of $5,000 and credit lease receivable for $5,000. Okay. Now we'll put it into practice here for a sales type finance lease. The Parker Shipping Company, the lessee, leases a standard hydraulic lift from Stroughton Trailers Incorporated, the lessor. It's going to be installed at one of Parker's loading docks. The lease, signed January 1, 2025, specifies that Stroughton grants right of use of the lift to Parker under the following terms. 1. The lease agreement is non-cancelable with a term of 4 years, requiring equal rental payments of $11,182.24 at the beginning of each year of the lease, an annuity due basis. Number 2, the lift has a fair value at commencement of the lease of $40,000, an estimated economic life of 4 years, and no residual value. The cost of the lift on Stroughton's books is $30,000. Number 3, the lease contains no renewal options. The lift reverts to Stroughton at the termination of the lease. And number 4, the implicit rate of the lessor is 8% and is known by Parker. Stroughton sets the annual rental as shown in the following calculation. Here's the fair value of the leased equipment, less the present value of the residual value, which is nothing, and that then the amount to be recovered by the lessor through lease payments is $40,000. Now, we're going to use a present value factor here and convert that $40,000 at an 8% return to $11,182.24. So, instructions here. Alpha, determine the classification of this lease arrangement for Parker, the lessee, and Stroughton, the lessor. Bravo, prepare the amortization schedule for the lease liability, the receivable, for Parker and Stroughton. And then finally, Charlie, prepare the entries and show the financial statement presentation of the lease arrangement through the lease term. Okay, let's look at A. Alpha, determine the classification of this lease arrangement for Parker the lessee and Stroughton the lessor. So the lease is classified as a finance sales type lease by both Parker and Stroughton as indicated by the following analysis. 1, transfer of ownership? No. Number 2, purchase option test? No, there's no bargain purchase option in this lease. Number 3, the lease term test? Yes, it's a 4-year lease term. 4-year useful life, 100%, greater than the threshold of 75%. Number 4, it also, yes, on the present value test. The present value of the lease payments is $40,000. And that's going to be divided by the fair value of the equipment. So we get 100%, and that's greater than the threshold of 90%. And the alternative use test, yes, as indicated, the hydraulic lift is going to be completely used up at the end of the lease. It will be of no use to Stroughton at the end of the lease. Therefore, the lease meets the alternative use test. So pretty clearly, the lease is classified as a finance/sales type lease due to meeting the lease term, present value, and alternative use tests. Remember, you only need to meet one of those classifications to record the lease as a finance/sales type lease. So note that when we calculate the present value test, we are comparing the present value of the lease payments to the fair value of the leased item, not the cost. The cost of the asset is relevant when we record the lessor's journal entry. Okay, so for Bravo, let's go back. Bravo, we're preparing the amortization schedule for the lease liability receivable for Parker and Stroughton. So here is that lease amortization table. And here's our payments, here's our interest, here's the reduction of the lease liability/receivable, and the effect of the amortization on the $40,000. All right. Okay, I think that's clear. We'll move on to the next. So now, here are the journal entries. For Parker, they're going to debit right of use asset for $40,000 with a credit to lease liability for $40,000. And also a debit to lease liability for the annual lease payment here, and a credit to cash. And then a debit to interest expense for $23,0542 here, and a credit to lease liability for the same amount, and then a debit to amortization expense of $10,000, and that's $40,000 divided by 4 years. And the credit is to right of use asset. Okay, so they show how the income statement and balance sheet would look after penning those journal entries for Parker, the lessee. Now, Stroughton would have a debit to lease receivable for $40,000, but they would also have a debit to cost of goods sold and a credit to inventory for $30,000 and a credit to sales revenue for $40,000. They would receive the cash for the lease payment and credit lease receivable. Pretty straightforward there. And then they would debit lease receivable for the $22,305.42 of interest and credit interest revenue. And here they show what their balance sheet would look like and what their income statement would look like. And they show here the second lease payment with a debit to lease liability and a credit to cash, as we did up here. And the second lease payment would be similar to what we did here for Stroughton. Okay. Now, if we look at Parker Shipping, now the interest expense and lease liability of $1,595.28. The amortization expense of $10,000. We're going to show that on the balance sheet and income statement as shown. And we go through that same process for the third lease payment and the interest accrued and amortization expense and its presentation on the balance sheet and income statement. And we do the same process for Stroughton. Here, 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 and here, and finally how we show that on the balance sheet and income statement. All right, this looks like a good place for us to stop this video, and when we return, we'll take a look at explaining the accounting for operating leases. Until that time, bye for now.